Well, joining me now for a look at what's playing out on our markets, the market scene at midday, is Cobus Potgieter from Southern Cross Capital. Cobus, hi, good to chat to you. Northern Platinum, of course, they're smiling. We'll be talking about platinum later on in the show, but these platinum prices are just going up and up and up.
Yes, good afternoon to you and your viewers, Ray. Absolutely. Focusing on Northern's update in particular, I guess with these mines, we always look for an unexpected miss. And in this case, we had the opposite. So the more mature operations at Boyson increasing output, some efficiencies being unlocked through the moving of activity from one side of the mine to the other. It seems like there is some very clever data optimization going on in terms of how to be blasting in some shafts whilst mining in others. And then, of course, Eland, the more greenfields operation, ramping up production nicely. And because of that, into an environment where these precious metals are rallying significantly today, platinum in particular, close to that high we saw in the middle of December. So it looks like in conjunction with gold and copper, platinum also getting a lot of support. It's a nice day to release this update because Northern is the best performing stock on the exchange.
Yeah, I mean, platinum at the moment you can't lose, but I remember platinum being $900 an ounce just yesterday, and now we're sitting in a different world. I would think, looking at world affairs, if I had a stock pick today, I'd put it right there.
Yes. It's a tricky one. It's a sunset industry, something which these guys acknowledge themselves. So to some extent, there is limited supply and there is no additional capex flowing into bringing up new capacity into this diminishing market. Ultimately, there's no real catalyst for platinum to see the sort of sustained demand we saw when a lot of capex was flowing into it 20 years ago. So, the trend is against platinum, but because of that, these guys have sort of an unrivaled industry with no new entrants, no new capacity, or very little new capacity coming into the market, and these older assets being, dwindling, but being converted into cash over time. So it's almost like, the sort of thesis for tobacco a few years ago. It's a nice, attractive business, even though it is diminishing over time. But at the same time, of course, subject to these enormous fluctuations in the spot price of PGMs. So, yes, I think the environment will remain constructive for platinum in 2026.
Yeah, all right. If you want a safe bet, Nvidia, that chip, now we played an insert over there, and you can see they're looking towards China. I did see a story on Reuters just before coming on air saying that China's saying, no, we're not going to let your chips come in. The US, I don't even think they're worried about that.
This is a decision by the current administration to be a little bit more business friendly, and of course accepting that these chips are bleeding into China one way or another, either through acquisition or leasing. Essentially, China and the universities and the AI players there can still get access to these chips literally by buying capacity in the data centers that are being constructed all over the world, wherever there is cheap energy to be found at the moment. So to some extent, it's seen as supportive, and that's certainly the argument Nvidia has been making. Protect our market share, protect our edge. Don't encourage Chinese players to invest in the technology and catch up to us technologically, ultimately. And China has, again, is a bit of a to and fro. They don't want to fall behind in AI, but at the same time, they want to stimulate the domestic ability. And for that reason, they have been pushing the likes of the domestic manufacturers like Huawei to develop their own chips, to develop their own techniques, to develop their own infrastructure without, indigenously, ultimately. So there's a bit of a to and fro, but it looks like in the short term, the environment becomes a little bit more friendly. But because of that uncertainty around whether or not it will even be allowed, and attached to these permissions are the conditions that they not be used for nefarious means, military means, impossible to enforce, of course, but there's an almost KYC. If you want to export a chip to China, you need to know the buyer is not military affiliated. That adds a bit of complexity, an additional friction. There's the reverse tariff where you need to pay 25% of the value to the US government when you export a chip to China. All of and then of course the Chinese themselves, like you just mentioned, potentially blocking that access off the bat. Yeah. So it hasn't sort of opened up the floodgates, and I don't think Nvidia's management will be particularly happy, but it is moving in that direction at the very least.
Yeah. Right, we all are looking at the oil price, Venezuelan exports resuming, oil price coming down a little bit. What are you seeing?
So I think, look, the expectation is there's a glut. There's too much oil production, and I mean, interestingly, as you mentioned, BP locally reflecting that we are still seeing declining demand as a trend, and that's a global phenomena. So, the market was almost speculatively pushing crude from 60 to 65 because of the events in Venezuela, and of course, I think more severely, the events in Iran. But we need to see the evidence of a supply disruption, or the effects of prolonged sanctions really leading to a disruption in stocks before I think that increase in oil price sticks. Now, as you mentioned, we've seen a third super tanker depart. The first two, speculatively, we don't have official word of this, but it looks like it's part of this 50 billion deal that was negotiated between the Trump administration and the new government in Venezuela, and the third one on its way to the Caribbean, which is of course houses enormous stockpiles. These mega tankers that are attached to the exchanges are largely housed there. So it looks like maybe it's business as usual, and at the same time we haven't yet seen major disruption from the events in Iran either. So that will, ultimately, if these geopolitical events don't lead to a decrease in supply, oil should drift down again.
We'll see what happens. Right, Cobus, hold that thought. Now, before we move on to your stock pick, let's take a moment to touch on which counters your industry peers are watching closely.
I'm choosing Capitec. They obviously own a lot of schools. They own tertiary education facilities as well. A small human resource business as well. They generate good returns, good cash. They've expanded into Africa. The demographics are very positive, both in South Africa and the rest of Africa. More children wanting quality education, and the parents working hard to pay up for the type of education that Capitec offers. And more people hopefully getting tertiary education, which Capitec also offers. So it's not too expensive, reasonably priced, very good business model, very good competitive position. That is why I would choose Capitec.
My pick is Lockheed Martin, the defense company. Now, we saw a lot of success in the defense companies last year, but mainly in Europe and Asia. And the US defense stocks actually lagged because all the new growth was coming in those other regions. I think we've seen a revitalization of that US defense sector. Lockheed makes the F-35s. They're very core to the US defense spending. You see them talking about upping their spending to $1.5 trillion potentially. They've got a very good order backlog. It's a quality business. There's a roadmap to unlocking growth in sales as they deliver on that order backlog, capturing some more of that margin. So it's a high quality defense player with a good position in the global landscape and in the US. So that's my pick, is Lockheed Martin.
So, Cobus, two solid stock picks there. Capitec, January, it's the month of education. Can't lose, I suppose.
Look, and it ties in nicely with our thesis around the SA Inc. stocks. It's the valuation is very reasonable, and we believe there is a continuous secular growth story in private tertiary education. Frankly, we are along the same stock. We love Capitec. It's high quality, and again, this entry point still looks remarkably attractive. Low valuation, good yield. And a nice way to play the sector. And overall, we are a bit more bullish the South African consumer as well in 2026. So it plays well into that thesis.
Right. And of course, if you're watching what's happening in the United States, Lockheed Martin, there's massive defense spending, I suppose.
So Lockheed is a particularly interesting one because of the order book. The order book was just alluded to. Ultimately, it'll come down to execution because these guys have more orders than they can fulfill for many decades, frankly. There's some deals at the margin, the likes of the Hellfire deals going to Europe that adds an immediate additional source of revenue. But what it comes down to ultimately is the manufacture and execution of these massive sometimes so-called classified projects. For that reason, and given the stretch valuation, I'm not that fond of Lockheed because they do sort of, you often get these disappointments coming through, something like their rival Boeing. We see similar effects. Same thing with Northrop, which is perhaps a more comparable one. And we still prefer the European defense stocks purely because, the valuations are less stretched.
Sure.
There is additional industrial ramp up and investment there, so they are winning additional contracts. And I think one of the major risks with the US defense stocks is the potential dismantlement of NATO, because these guys have been massive beneficiaries of NATO exporting to all of those nations, and Trump's sort of pressure on NATO, the likes of potential annexation of Greenland, that could lead to more indigenous development by the Western allies within NATO, which will be more supportive of the European manufacturers. But to give you an idea, last year, if you bought a US defense stock ETF, you were up 60%, 60. If you bought a European one, you would be up 90%. So these are hot sectors, but I still believe the European defense sector offers more value.
Right. What is your hot sector? What is your stock pick?
Perhaps a bit more boring than Lockheed Martin and F-35 jets. We are going with Capitec, again tying in with that same thesis. It is not only a high quality business, but it is securing secular growth opportunities, managing to sell new products, the likes of life and even cellular, into their client base. Disrupting all the industries they compete in through technology. It seems to be incredibly well managed, and it's gone sideways a little bit. The float's expanded as a consequence of the Kiro and the Jannie Mouton Stichting deal, and it's just one of our nice core picks for SA Inc. to outperform. And I think, again, given that ultimately we think the rand remains robust, oil remains suppressed, inflation remains suppressed. That creates more room for interest rate cuts. Bonds are not attractive at the moment. The real yields have really come down. Money market will become less and less attractive as these cuts continue. Eventually, surely we should see a redeployment of capital into South African businesses and into South African equity. And I like being positioned into a really attractive SA Inc. stock, the likes of Capitec, for when we believe that revaluation comes through.
It's a very strong bank. Indeed it is, Capitec. Cobus, thank you so much. Good to have you on the program once again. We do appreciate you taking the time. That was Cobus Potgieter from Southern Cross Capital.